The housing market is in trouble and is starting to show signs of cracks. And although stocks are going higher, that doesn't mean that real estate will follow. Let's dig in how we got here and what to expect moving forward by looking at the data that I collected from this week from various sources. So let's jump in. The first thing that I want you to know is that real estate prices are a direct reflection of what is going on with interest rates. So you may have heard realtors say, prices always go up 4%. This is simply not true. What we've actually seen is the story of interest rates, which is the number one influencer, in addition to supply and demand, of course, of demand, is the 10-year treasury rate. Why the 10-year treasury rate? Because the average duration of a mortgage is about 10 to 12 years. It's very closely tied to the 10-year treasury rate. And frankly, rates have been coming down for the last 30, 40 years from 15% all the way down basically to near zero, and now have bumped back up to about 4.5%. Today, we're seeing mortgage rates in the sevens, depending on your credit score and different situation. But frankly, interest rates have fallen a long time. That's why real estate prices have continued to go up every single year. And when we have interest rates start to have an inflection point, start moving up, that's when you're going to start seeing prices come down. That's why my wife and I in 2022, March 2022, the Fed came out and said, hey, we're going to raise our overnight borrowing rates. We know that's going to influence mortgage interest rates, and of course it did, and rates came up from there, and we're very happy that we sold our portfolio and got our money out before correction started to happen. So here's what I was referring to, why mortgage rates are closely correlated with 10-year bonds. The average is about 10 years that people stay in their home, so the duration of the bond is not a 30-year, it's usually around 10 years, and that's why they're very closely correlated with each other. So let's jump into housing inventory. This is where the nightmare really begins. Just to talk about the COVID pop from 2020 to 2024, this chart is awesome. It just shows the growth, the change in population in specific areas. As you can see, Jacksonville in Florida was a main beneficiary. Texas, especially Austin, Texas, and Dallas were main beneficiaries. And you saw people moving from the Northeast and from the West out in California down to these lower cost red states that were more tax incentive and open during COVID. So we just saw this massive boom, particularly saw booms in pool homes that people weren't used to the heat, so they wanted to have that pool and they wanted that dream pool home, especially in Florida. So we had this huge COVID pop that occurred, and we had a ton of population coming in. And frankly, right now, we're seeing the opposite. We're seeing inverse COVID. We're starting to see people in 2025 leave Florida and go back to the north. That data I'm sure will come out. So what happened? Home price run-up was just absolutely dramatic from 2020 moving forward because the interest rates dropped from the Fed. The Fed also started buying mortgage-backed securities to bring mortgage interest rates down. They bought $2.74 trillion on their balance sheet of mortgage-backed securities, which is just a tremendous amount. And obviously you can see that the speculative markets in Florida and California just had this incredible pop, along with technology stocks that influenced the California market too. But we saw this massive run up in home prices that we're now dealing with today. So we had the population growth because people are moving because of COVID, and then that led to the Florida prices just skyrocket. Obviously, the existing home sales popped during that period of time in 2020 and 2021, where we had record sales. Agents were going crazy and having just a phenomenal time. And then boom, what do you know? In March 2022, rates started going up 4.75%, and housing sales just plummeted very quickly. Then the Fed stopped raising rates, and it's kind of just trickled down from here. We're at the lows of the 08, 09, 2010, we're at the lows of those existing home sales. So it's a pretty rough spot out there for real estate agents, specifically for real estate investors. And we expect this to continue for some time. And frankly, the last few days we saw, the Trump tariffs announcement come out with China, which boosted the stock market quite significantly. We're almost up to flat from the beginning of the year. But stocks and real estate are completely different asset classes. The main thing that we're tracking is that 10-year treasury rate just cracked 4.5%. So it's likely that if rates stay elevated or continue their upward march, that we see existing home sales continue to go lower because of affordability problems. Here's a crazy chart that I found this week. Florida has more housing inventory than the entire Northeast. And so you can see this chart kind of trickling through. Northeast housing supply, this is New York, New Jersey, Connecticut, Pennsylvania, Massachusetts, Rhode Island, New Hampshire, Vermont, and Maine. And you see Florida's housing supply just starting to skyrocket, starting really since that March 2022 bottom when the Fed started raising rates. So this is just a direct reflection of what the Federal Reserve does to influence interest rates, which completely determines what is going on with the housing market. Now, of course, Florida housing supply has also been factored in by builders completely overbuilding. They thought the COVID demand was going to be permanent and people would continue to relocate, and they just overbuilt and got way too excited and thought that it would be permanent. It's just not the case. So here's a shift in statewide activity. I think this chart, it's a little bit different. It just shows you a little bit of like which states are really struggling, which states are doing well. Obviously, these ones here are not being impacted as much in the ones at the top, right? So that are having the issues. Florida and Texas, the place that people are relocating to. Colorado is starting to see some cracks. Arizona is getting a little bit scary out there with the news coming out there. Idaho, Washington, Utah, and Hawaii, and we're starting to see more states start to experience what Florida is experiencing, which is, slowdown in buyer demand and a buildup of inventory. And we expect this trend to likely continue. The entire United States does not go at the exact same pace. There's certain areas that are impacted more than others based on, affordability, wages, employment, all of those other type of factors in their local economy. So here's the home values year over year growth. This is for March 2025. This comes from Arbor Research and Trading with Reventure. If you don't follow them, you should. They have some good data that comes out, but you can see that Arizona is hurting. You can see that Texas is hurting, and obviously Florida is the laggard of the entire group. And that's where we are. We're over here in Jacksonville right here. And we are a very speculative market because we had the hedge funds buying up a bunch of single family rental properties all the way from 2014 up to 2022. Once the Fed started raising rates, the numbers no longer penciled out. They dropped out like flies. Like it was like overnight, all the wholesalers' businesses stopped, all the flipping stopped, and people started finding other things to do. This is just another chart showing that, hey, existing home sales are, basically at the record low. Just another way to look at it in a bar chart. Ultimately, what this has led to is just an absolute affordability crisis. What you need to earn in order to buy a home today is about 70% higher than what it was previously. And the mortgage price payment index shows this. So Americans, this is from Realtor.com, Americans need to earn about 70% more today than they did 6 years ago to comfortably afford a home. That's crazy. I don't know anybody really who's got a W-2 job who's earning 70% more than they were 6 years ago. In fact, a lot of people are scared about the AI technology taking their job. So this is one of the things that you need to be on the lookout for. It's just on paper for the amount of wages, like either prices have to come down or the amount of that people earn has to go up. And it's more likely that people, that prices will come down than the earnings to go up based on the tech stack coming. So here's a little bit more recent data from March 2024 and March 2025. How are prices doing? You can see that a lot of states are now negative and becoming more negative as things move on. So 49 of the nation's 50 largest metro areas have weaker year-over-year home prices this spring versus a year ago. So this spring really, at least in Florida, does not feel like a spring market. It kind of feels like we're facing some seasonality, like you would feel after school starts, after August. And seasonality is a big thing in Florida. So usually February, March kicks off busy season. People get their tax refunds back. They're excited to go out and buy. And then in August, when school starts, prices tend to come down about 2% until the end of the year, and the number of sales fall about 50%. So the end of this year is going to look really dangerous in terms of the number of home sales that are happening and the amount of inventory that stacks up. This is another chart I found this week is really interesting. Manufacturing slowdown. This is the Philly Fed's new orders. Anytime that it hits this little part right here and goes under this index, we've had a recession that followed within the next 6 to 12 months. So it's highly possible that we have a recession. Who knows what the Fed's going to do, if they're going to continue to prop things up or Trump's going to come out with another executive order to push things up. I don't think that's going to happen. My outlook is the next 2 to 3 years, we're probably going to have some sort of another 20-30% downtrend on stocks. When it hits, you don't know. The market can completely stay disconnected from Main Street for a very long time. So there's no telling when this stuff is going to happen. We're just following the data, and the data is pointing to a manufacturing slowdown, which usually creates a recession that's soon to follow. So here's the history. Here's just some information that came out from a long time ago. The history is rhyming, and this is just a reminder. In 2007, home inventory was relatively low in the Northeast and Midwest, kind of like what we're seeing now. And even as the Sun Belt was flooded with excess supply, that's what we're seeing now from years of speculative building. Yes, amen. That's what we're seeing. Markets like Phoenix, Las Vegas, and Miami had seen a construction boom fueled by investor demand and easy credit. It's exactly what we're experiencing right now. By mid-2007, these areas were oversupplied, with inventory surging as demand fell. In contrast, the Northeast and Midwest had slower population growth, tighter zoning laws, and fewer speculative builds, keeping inventory levels more stable while the housing crash hit the Sun Belt. Man, you could write this about today's market, and it would almost be identical. Obviously, there's a few changes from what we had previously, but the construction boom, the speculation, the investors who've come in and gobbled up these single family rental properties. And frankly, I've had a couple people reach out to me from hedge funds that are looking to sell 200, 300, 400 units of their rentals because the insurance has spiked. So let's talk about that. The insurance premiums are just insane. In Florida, look at that, $15,000 for the average insurance premium. I can tell you in the last 5 years, insurance premiums in Florida have gone up 72%. Of course, we have the hurricanes and natural disasters, but still, I mean, it's a crazy amount of insurance that you're paying on your house. And sometimes, year over year, it's almost doubled. So I feel like the number's higher than 72%, at least in my personal experience. But, around the country, you can also see over here, Texas has gone up, but basically the projected annual premiums have gone up. So this is the average annual cost of home insurance projected for 2025. It's high, and unfortunately, it seems to be going higher. And this comes from Arbor Research and Trading. So let's look at this. We've got record prices, we've got speculation and wealth. So I'm going to go over a couple more charts that were interesting this week that I wanted to share with you. The wealth accumulation, this is a crazy stat. Top 1% of earners now have more wealth than the middle class, the entire middle class. This is part of the problem. The wealth is just accumulating at the top, and the middle class is not getting the wage increases that they need to be able to afford properties at these prices and these interest rates. Office delinquency, obviously we knew this was going to be an issue during COVID. Now people are kind of permanently working from home, or they're going to have to transition their office into some sort of other asset class. But office delinquencies are the first to fall from the commercial side, and they're having a bunch of issues. Interesting real estate brokerage models have popped up over the last few years. Here's one, EXP, their stock is down quite significantly. And frankly, a lot of these EXP agents rely on their revenue share models and on their stock to continue to go up for their retirement. And the problem with that is when the market goes down, when you actually need the money, your revenue share dries up and the stock price falls. So it might be a cool long-term play if you got in early and got in at the right price. But this is highly speculative stuff, and this company has to continue to buy back their shares using their free cash flow because they pass out shares to their agents for their performance. They have to use their free cash flow to buy back their own stock to avoid dilution. And that's where a lot of the cash flow goes. So it's a really interesting model. There's a couple different models like this, but the problem is right when you need the money, it's not there is when you're looking at it from a real estate agent perspective. This is one of the conversations I'm having with real estate agents every day. They feel bad telling their buyers to continue buying, but the reality is it's better to rent financially on paper in a lot of circumstances. If you plan on staying in the home for 2 years, it's probably better to rent. If you're planning on staying in for 10 and it's like a very, very long time hold, I think you'll be fine. Time usually cures all the issues in real estate. So as long as you're able to hold on to the asset and it's not, a gigantic liability where you can afford the payments, go for it. Unfortunately, the case is that that's not the case. Most people are completely leveraged up in debt and are buying near the peak. And if they were going to lose their job, they wouldn't be able to afford the payment. Or if they were earning less in the future, they wouldn't be able to afford the payment, and they'd have to give the property back to the bank or short sale the property. So, Americans are falling behind on their car payments. So any asset that is backed by debt, we're starting to see a little bit of an increase in delinquencies. So obviously car payments are starting to have issue. And this is the one chart that I love the most. This is the one chart to rule them all. It's if you are going to keep the value of a house as interest rates change, if you keep an 850 payment constant. So, obviously you have You can pay for a house that's $462,000 when you have a 2.7% rate, but when it goes to 7%, you can only afford a $280,000 house. And the difference between those two is quite dramatic. $180,000 goes, a really, really long way for what you can buy in which areas. So this is the one chart to rule them all from an affordability standpoint. And I think this tells the entire tale. This is the credit crisis. This is what I was referring to with the loans with a debt. DTI means debt to income greater than 43%. FHA, 65% plus of people using an FHA loan have a debt to income ratio greater than 43%, which means their already existing debt is more than 43% of the money that they have coming in. VA is really high as well, almost 60%. Fannie, Freddie, a little bit better, and then the portfolio loans as well. But this is just, we're in a credit crisis. People are just leveraged up to the T's, and this is why I don't think it's going to continue. I don't think that housing is going to continue to move up. I don't think the stock market's going to continue to move up. The consumer is strapped for cash. They've run out of their savings, and there's going to be a due date. Do I know when that due date is going to be? No, I can't time the market. No one knows how to time the market with this stuff, but at some point, this stuff will crack and the balloon will pop, and this debt crisis will move forward. If you do some research, you'll find that there's no easy way out of a credit crisis. There's no way to not feel the pain. The pain is guaranteed. It's just how to crack the egg at this point. With that, thank you guys for watching. If you want to subscribe, go ahead and subscribe. Comment below. What do you guys see going on in the stock market? What do you expect to happen in the next 12 months? What are you seeing on the ground in the real estate market? Would love to hear what you guys are talking about. Thanks for subscribing, and see you next week.